Hello, good morning to all. Welcome to today's Daily Dose of Market Insights by OANDA, presented by myself, Kelvin Wong, the Senior Market Analyst of OANDA Asia Pacific. So very good morning to all. Today is actually the 27th of September, Wednesday. All right, so before we start our Daily Dose of Market Insights, let's take a look at the disclaimer first. All right, so leverage trading carries a high degree of risk and may not be suitable for everyone. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product. All right, so as usual, for those who join us for the very first time, all right, so these are the three key takeaways from our daily dose of market insights. Firstly, we will recap what happened last night in terms of market movement, as well as key data releases or events. And secondly, what are the key events or economic data releases to look out for today? And lastly, we will actually round out with a short-term technical outlook on the various asset classes that has started to exhibit very interesting technical configuration. So let me start off with what happened last night first. In terms of the global markets. So over here last night, what we could see over here is that the markets actually reacted according to our expectation. For those who actually joined in our previous daily dose of market insight since 2 weeks ago on the daily basis, we did actually highlighted there's this very key medium-term technical weakness on the benchmark US stock indices, and indeed that the benchmark US stock indices from Dow Jones, S&P, the Russell, the Nasdaq 100 continue to actually shape further decline yesterday. So all in all, what we could see over here is that right now we are approaching coming 2 more days before the end of the trading month of September ended. So if the Nasdaq, if the US benchmark indices continue its downside momentum, so right now month to date for the month of September, on the average, they actually loses close to between 2% to actually 7% of range between the 4 of them, the 4 key US benchmark indices. So they are actually looking to actually close for September the worst monthly decline in terms of monthly decline since the start of this year. All right, so now let us focus more on my screen instead. So let me show the things that I want to share with you all. All right. Okay, so let me hide myself. Okay, so this is the heat map of the S&P 500 component stock yesterday. So what we could see, pretty much obvious, all of them are actually in the red, or most of them. And most importantly, I want to highlight is the one that has larger square or larger boxes. So these larger boxes are actually indicating to us the market cap, the size of the market cap of the component stock inside the S&P 500. So you know that the famous 7 mega big cap, the Microsoft, Apple, Amazon, Google, Tesla, Meta, and Nvidia, due to the AI boom that was actually being in Fed since the start of this year, all of them actually closes in the red. And most starkly, Apple, the biggest market cap, actually underperformed the market. The worst performer, I would say, second worst performer, negative 2.34%. The worst was Amazon, negative 4%. So this actually create a negative feedback loop into the broader US stock market. So later I'll share with you all the technical configuration of the US market, even though the one that is still holding kind of better perform is the Dow Jones, but the Dow Jones has already broken a key technical element as well. So do be patient. I will share with you all on the technical outlook when we come towards the third session of the daily dose of market insight. All right, so pretty much in the bad shape. So kind of a risk off environment in the US stock market, and in fact across Europe and Asia as well for yesterday. So the dollar actually strengthened yesterday across on the European currency, but not against the CAD, not so much against the Aussie and Kiwi, but more on the European currency, like against the Swiss, the Euro, and the sterling, the British pound. And also oil prices going to remain firm. The WTI crude oil price holding above the 90 level. Okay, then gold actually tumbled, went close to the XAU/USD retested the psychological level of 1900. So now let's us talk about the economic release for yesterday very quickly. So what we could see over here, let me highlight to you. Okay, put it in better. All right. So yesterday, okay, let me put it this way. See much clear. Okay. So over here, yesterday there was industrial production release in the afternoon, US 1 p.m. Singapore time. So the industrial production in Singapore actually tumbled below expectation, negative 12.1% year on year versus consensus of negative 3% year on year. So this is the 11th consecutive month of decline, and this decline is the worst in, if you look at the last 5 years or 10 years. So it's actually close to a 10-year low on the month of August. All right. So what it means that over here is that Singapore itself being a international export hub with a very weak industrial production figure for August. So what it means over here is that the global economy is actually not doing pretty well. So what does it translate over here is that there's actually a higher odds of the major economy, especially US. I don't know, based on these figures that I see over here, is that the odds seems pretty slim of a soft landing, but we perhaps the odds of a recession, global recession, has started to actually indicate a rise as well, due to the fact that Singapore being a international export hub start to show such we call it horrendous or lackluster industrial production report or figure or release. Now, that's for the Singapore side of the story. Then over at US, right, the important one is the consumer confidence. As you all know, that consumer confidence, why is it important? Because a significant bulk of the US economy comes from consumer spending. That means, i.e., through the services activities. So what you see that consumer confidence, right, came in at 103. So what market expecting is 105.50 over here. So this conference board consumer confidence has really shown signs of what I call weakening since July. All right, since July. So right now it's actually 2 consecutive months of growth slowdown in terms of consumer confidence. Okay, so if you want to see the chart of consumer confidence, right, the trend. Okay, over here, because due to copyright issue, trading economics, we're not able to show the chart over here. So you will click on the link, you are able to see the trend of the consumer conference board consumer confidence. So what I could do is just Google it. Okay, you type conference board consumer confidence. Right, click on here. You're able to see the trend. Okay, this is quite part of it. It was September, so this the release was in September. So you look at the trend over here. So the earlier summer peak seems to be over. So right now the consumer confidence has now started to decelerate in terms of the optimism. All right, so it's actually July, August, September, yeah, the 3rd consecutive month of growth optimism decline. Okay, so if this usually, right, consumer confidence is one of the leading economic indicator. If this is going to decline and break below the low of printed earlier, the earlier part of this year over here, potentially, right, it also indicates chances of a soft landing in US is rather slim, but rather we are heading more into either a hard landing or a recessionary scenario. Okay, so all this, right, actually feedback, it has a negative feedback loop into that risk off scenario that was played out in the global stock market yesterday. Okay, so now early this morning, before we start our daily dose, there are a couple of events that took shape is from China. So China central bank policy, PBOC, actually released some statement. So this I will call it verbal intervention to actually calm the fear, the negative feedback loop in the China stock market. So recall that at the start of this week, Evergrande, which is the one of the major China property developer that actually has kickstart this liquidity crunch scenario in the China property developer market. Evergrande itself was actually created a big hoo-ha at the start of this week. Number one, they failed to make a due localized yen onshore bond payment, and also their restructuring plan seems to be being scrapped right now, okay, due to the fact that there's some negotiation going on with their creditor. But what I could see early this morning, the central bank actually used this word precise forceful policy to bolster recovery. So it's a bit of verbal intervention, right, to calm the fears of the market. So how does it impact the stock market? For sure, definitely it will impact the stock market in the very short term. So later I'll share with you the technical configuration of the Hang Seng Index. So what's interesting over here is that this verbal what you call it messaging actually came when the Hang Seng Index hit a key short-term support, okay, which we highlighted yesterday. So later I'll talk more about the chart when we go to the short-term technical outlook. Now, BOJ. Okay, so BOJ early this morning, they released their minutes. So this minute was not last Friday meeting. It was actually the July meeting. So this was released earlier this morning. So there was actually a debate going on that highlight the rift in the view of the rate hike timing. So what we could see over here within the BOJ is Bank of Japan to put it. So Japan monetary policy is always being a forefront right now. Why? Because Japan is still the only major economy that has negative interest rate. All right, the rest of the major economy has really starts to actually tighten their monetary policy 1.5 years ago. But Bank of Japan is still lagging behind. They are doing some tweaks here and there, especially on the yield curve control. So right now, there's a rift on the policy rate. Whether will they want to actually start to tighten it to bring it to positive? Because right now it's still negative 0.1% at the early part of next year. All right, so there's actually a mix, kind of a mix, we call it a situation over here. So one saw risk of Japan US style inflation, and there's another one saying that wage growth could be stagnant. All right, so there's this broad divergence view over here. So means, i.e., what you could see over here is that not all BOJ officials are dovish, as equally dovish as the governor. Okay, so something to look out for, especially as the months as what I call this Q4 unfolds this year, to look out for if there are any signs of confidence in BOJ to actually start tweaking its negative interest rate policy to bring forward it to the start of this year. So especially one of the data look out for will be this Friday. There will be the release of this leading Tokyo inflation data for the month of September. Okay, now, so what are the key economic data to look out for today? Okay, so today is Wednesday. So if we look at towards later part of the European session, you have 2 p.m. You have Germany consumer confidence out at 2 p.m. Singapore time. And over at the US, over here, you will have durable goods, not so much of an importance, but market still plays a bit of attention to it. So that actually impact more on the industrial sector of the US or the industrial stocks. So durable goods orders for the month of August will be out at 8:30 p.m. Singapore time. All right. So just out over there is over here is the industrial profits of we call it a state-owned firm in China. So year to date for the month of August, yeah, they're still showing decline of negative 11.7%, but this decline actually came in lesser than negative 15.5% that was recorded in the previous month. So if you look at the trend of the industrial production, yes, it's still contracting over here. Okay, this is the absolute amount. So it's still contracting over here, but the contraction, the year-on-year contraction rate has starts to reduce slightly. So it's still too early to tell whether is China start to turn around from the risk of deflationary spiral. But definitely for sure that this coming Saturday, there will be a release of the China PMI data for the month of September, services and as well as manufacturing. So if we start to see some signs of further improvement in the manufacturing PMI data, which has started to show improvement in the month of August, so there's actually a higher odds that the deflationary risk has started to stabilize in China. So we should watch out for that data coming forward on this weekend. Yeah. Now, very quickly, right, let's take a look at the technical right now. Okay, so before we start the technical over here, I want to highlight for yours the longer term. Okay, so this is the cash market of the US benchmark indices. So let us start with the S&P 500. All right. So the S&P 500 over here, right? This is the weekly chart. So this is the 200-day moving average. So I overlay on the weekly chart so we could see pretty clear. So for now, for sure, the Dow Jones has already broken below the 200-day moving average. So it's pretty much of a concern over here. Prior to the breakout of that 200-day moving average, it really broke this ascending trend line support that is in place since 13th of October low that was supporting that that what I call that 6 or 7 month up move previously. But however, this up move over here hit a resistance level, a medium term resistance level at 35,490 start to break down this ascending trend line support level last week, and right now this week, if it continue its momentum in the next 2 days and continue to be below the 200-day moving average, there's a high chance that the rally from 13th of October 2020 low is only a corrective rally. We in this major downtrend that has taken shape from the all-time high to last October low. That means there's actually a chance for it to actually retest the October low right now, because this is only a corrective rally rather than the start of a impulsive up move to show higher high to take up the previous all-time high that was printed in January last year. Okay, so that's the pretty much weak technical configuration we are seeing in one of the benchmark US indices, which is the Dow Jones. Okay, pardon me. The weakest one over here is actually the Russell 2000. The Russell 2000 also represents a much more represents the state of the US economy. Why? Because the Russell 2000, the component stock of the Russell 2000 derive majority of their revenue inland from the US economy rather than internationally. Like Apple it derives its revenue from an international perspective. So I could see over here, right, being a stock benchmark indices is always tend to lead the economic cycle. For sure, the Russell 2000 looks pretty bad, even though from the low of September, October, it didn't shape higher high, but rather it started to congest within a symmetrical triangle range configuration. It really broken down the 200-day moving average last week, and right now it's trying to break below the lower boundary of this ascending triangle range configuration that's in place since September and October last year. So all in all, what you could see over here is that this is very clearly a sign of a consolidation. A breakdown would imply that potentially we may start to see a break below that October and the low of June last year and September, October low, which is at 16,520, and potentially to resume its another leg of major downtrend to take it much lower. So what I could see that the technical configuration of the Russell 2000 and the Dow Jones Industrial Average, there is lower odds for the US benchmark indices to shape what I call the start of a new impulsive up move to see fresh all-time high, but rather the rally that was seen in the multi-month rally that took shape since October low last year is more like a corrective rebound, or we call it a multi-month dead cat rebound, before we start to see the potential continuation of an impulsive down move. Okay, so all in all, based on the technical configuration of the S&P, of the Dow Jones and the Russell 2000, it seems to us that we are now in the creeps of a major risk-off scenario. But for sure, within short term, there could be counter trend corrective rebound. Short term, we talk about 1 to 2 days. But overall, the bigger picture is more skewed towards a major risk-off scenario. Okay, so that's for the broader picture of the US stock market. So now, very quickly, right, let's take a look at the S&P 500 first and the Nasdaq. That's for the longer term. So on the weekly chart on the S&P, is still holding above the 200-day moving average. Okay, on the Nasdaq 100, okay, it still have a fair bit to go before testing that 200-day moving average. All right. Okay, now let's go on to, since we are talking about the indices, right? So let's now shift our focus to the short-term technical outlook for today on the indices. Okay, so just now I share with you, I'll recap again, that this particular set of chart is more for a longer-term perspective. Okay, so now let's go down to the shorter-term perspective of the Nasdaq, of the benchmark indices that I share with you for today. Okay, so let us start with the Asia side of the story first. Okay, so for the Asia side of the story, this is the Hong Kong 33 index. So Hong Kong 33 index, yesterday we do have a bearish bias looking for the support to be tested at 17,370, which indeed it tests that support level yesterday. And right now, you look at the RSI, lower low, the RSI has now start to shape a higher low over here. Okay, this is a lower on the index, but the RSI has to shape a higher low right at the oversold region. So indicate to us, right, this down move over here from the high of last Friday all the way to yesterday's low, which is hitting close to the support of 17,370 level. The momentum, the short term, let me stress the word is short term, the short term momentum has starts to dissipate. That means, i.e., there is actually a higher odds right now based on the current short term technical configuration showing a potential bullish counter trend bias move, condition move. So I'll be using 17,370 as a key short-term pivotal support for today to actually potentially look out for this minor short-term bullish counter trend condition to take shape. Next resistance to come in at 17,870. A break above 17,870, which is this minor descending trend line in place since 4th of September, potentially exposes the next intermediate resistance at 18,370, which is also coming close to the 50-day moving average. All right. However, if we still start to see a breakdown below the 17,370 and hourly close below it, then this bearish short-term bearish condition shall resume to test the next support at 16,800. That's for the Hong Kong 33 index. All right. Now moving on to the European one, which is the German DAX over here. So the German DAX yesterday, we have a short-term support at 15,245. This level had already been met. It plunged down as expected. So for the German DAX itself over here, there is no bullish divergence on the RSI as compared to the Hong Kong 33 index. So we will be using a much more tightened key short-term pivotal resistance for today at 15,455 to have a continuation of our short-term bearish condition on the German 30 index to test the next support level at 15,020/14,930 level, which is so the lower boundary of this minor ascending channel of this medium-term ascending channel in place since 31st of July high this year. But however, if you start to see a breakup above 15,455, then this short-term bearish condition will be invalidated to see a squeeze up to test the next intermediate resistance at 15,600, which is also the 200-day moving average acting as a resistance as well. Okay, so that's for the German 30. So moving on will be the US indices. So let us start with the Dow Jones Industrial first, which is the Wall Street 30 we call in our platform. So the Wall Street 30 also hit our support level yesterday, which at 33,630 before shipping a bounce. No clear bullish divergence on the RSI. So I will actually use a slightly tightened key short-term pivotal resistance today at 33,870, which is slightly above the 200-day moving average to maintain that short-term bearish bias condition. A break below 33,630 exposes the next near-term support at 33,360. So what's 33,360 is in fact the lower boundary of this minor descending channel that is in place since 31st of September high. A breakup above 33,870, that means a clearance with an hourly close above it, shall invalidate our short-term bearish condition bias to see a squeeze up to test the next resistance level, which is the swing high of 22nd of September and 23rd of September at 34,150, and also close to the 50% retracement, FIBO retracement from this start of this current minor impulsive down move, okay, from the high of 21st of September high to yesterday's low. Okay, so that's for the US Wall Street 30. Now switching on, next will be the Nasdaq 100. Okay, so the US Nasdaq 100 also hit our support yesterday at 14,570 level. No clear signs of a bullish divergence. Price action going to shape lower low. RSI also lower low as well. Okay, so no clear bullish divergence. So we will actually use a much more slightly tighter key short-term pivotal resistance for today at 14,710 to maintain our short-term bearish bias. A break below 14,560 potentially expose the next support area at 14,370/14,300, which is also the lower boundary of this short-term ascending channel that is in place since 15th of September, as well as this longer-term major trendline support level, okay, that is in place since the start of this corrective rally from 28th of December low. All right. Now, however, if you start to see a breakup above 14,710, then this short-term bearish bias will be invalidated to see a squeeze up to test the next resistance level at 14,910, which is also close to the 50% retracement of this minor the start of this minor impulsive down leg, 38.2% retracement. All right, so still maintaining that short-term bearish bias on the US indices, the Nasdaq 100, the German 30, the US Wall Street 30, with the acceptance of the Hang Seng 33 index due to the fact that there's a bullish divergence. So for the Hang Seng 33, the Hong Kong 33 index, potentially we are looking for a minor bullish counter trend rebound scenario. All right, now moving on to the FX space. So yesterday FX, the dollar continued to strengthen against the European currency. So the weakest hit was the sterling pound, but sterling pound hit that support level. So let's immediately go down to the US indices. Okay, so now let me open the chart. All right, okay, where is the sterling? Okay, good. So this is the sterling pound. So the sterling pound over here, right, has kind of hit our short, coming very close to the lower boundary of this channel at 130. Okay, the 150 was our support level. The lower boundary of this channel is at 31.30 over here. So over here, right, at this point in time over here is that there is actually no signs of a bullish divergence yet at this point in time. So what I could do over here, right, for today, I will have a, because it's coming very close to the channel already, yeah. So I will actually have more of a neutral bias for today instead. Okay, at 31.30. Okay, let me remove this 21.50. Okay, neutral between 31.30 and over here this level. So that's actually yesterday's US session high at 122. Okay, 122 figure. So neutral between 122 figure and 121.30 for today, unless we have a clear breakup, that means above 122 figure, then potentially we could see a very short-term minor counter trend rebound to test the next resistance at 122.70 followed by 123.70. But however, if we start to see a breakdown again, then this impulsive down move should continue to test the next support at 120.50 for the sterling dollar. So now let's move on to the euro dollar. So euro dollar over here is that yesterday it going to tumble, going to shape lower high, lower low, trading within this medium term descending channel that is in place since the high of 18th of July this year. So still no clear signs of what I call a short-term bullish reversal yet at this point in time. The RSI also continue to shape lower high over here, and previously it managed to break down of this short-term ascending trend line support as well. So continue to hold on to this short-term bearish condition bias on the euro dollar. So have a much more slightly tightened key short-term pivotal resistance for today at 106.30. So as long as 106.30 key short-term pivotal resistance is not surpassed, potentially the euro dollar going to churn down much lower to test the next support level at 105.15, which is the lower boundary of this medium-term ascending channel that I highlighted earlier on. So, but however, if we start to see a clearance with an hourly close above 106.30, then potentially we may start to see the start of a minor bullish counter trend rebound to test the 20-day moving average, now acting as a resistance at 107.10, which is also this minor congestion zone area over here from 12th of September to 21st of September. Okay, so still maintaining that short-term bearish condition bias on the euro dollar, potentially to see a kind of a residual push down to test the support level at 105.15. Okay, now moving on to the dollar Canada, I'll share with you all. So dollar Canada right now is very that counter trend short-term rebound since last Tuesday has now coming very close to a key short-term pivotal resistance level, which is at 135.40, which is so close to the 20-day moving average that is acting as resistance as well. So right now, right, potentially, if you look at the current rebound that was seen yesterday, over here, price action going to push up higher. Okay, but however, the RSI has started to shape a bearish divergence at its overbought region. All right. So what it could mean that this last leg, this recent rebound since yesterday, is more or less starts to lose its momentum, its positive momentum, and that previous what I call that impulsive down move since the start of 8th of September may resume. All right. So using 135.40 as a key short-term pivotal resistance, looking for a potential a short-term bearish bias to test its intermediate or near-term support level, which is the swing low area of last Friday at 134.40 in the first step. A breakdown below 134.40 potentially sees the next support at 133.70. However, if we start to see a clearance with an hourly close above 134.40, then this we call it corrective, minor corrective rebound on the bullish side of the story may continue to extend to test the next resistance at 135.90 on the dollar CAD. So now we do have a short-term bearish bias condition on the dollar CAD. Also, intermarket correlation is being supported by a firmer oil prices as well, as long as 135.40 key short-term pivotal resistance is not surpassed to the upside. All right. Now, lastly, very quickly, let's go on to the story of dollar yen. All right. So for dollar yen over here, what we could see at this point in time, okay, it's now trying to get to be a bit of hesitant below. Yesterday we have a target, we have a resistance level to watch at 149.45 for a bullish bias. So this resistance almost hit yesterday, printed a high of 149.20. Yeah, 149.20. Okay, so more or less be hit. So we do have a bearish divergence that's being flagged out on the hourly RSI as well. So indicating to us that this push up from 22nd of September is losing its upside momentum in the short term. So I'll be using 149.45 as a key short term pivotal support for today to look for at least a pullback to test this intermediate support level at 148.40. Only a clear breakdown below 148.40, then we could start to see a more substantial corrective decline to test the 20-day moving average, now acting as a support at 147.50, also confluencing with the swing low area of 21st of September and 21st of September swing low. All right. So flipping to a much more of a bearish bias condition in the very short term for the dollar yen, as long as 149.45 is not surpassed, but the first support to look out is only at 148.40. All right. Unless this level break, then we could potentially see a more substantial corrective pullback or decline towards 147.50. However, if we start to see a breakout above 149.50, then this continuation of this bullish trend should continue to test the major resistance at 149.80/150 figure level. Okay, so that's sum up for the FX space. So for the FX space right here is rather mix over here. So we could start to see dollars strength to continue, more of a residual push down on the euro dollar, but neutral on the sterling dollar, and bullish, bearish for the dollar CAD and bearish for the dollar yen in the short term for today, given as long as those pivotal levels holds that I described earlier on or highlighted earlier on. Now, one more market to share with you all will be the WTI crude. So WTI crude will be the Texas oil. So after still recall that about 1.5 weeks back, we do have a bearish bias to look out for that corrective pullback. So that corrective pullback is almost met yesterday during the European session, hitting a low of 88.66, which is very close to the 20-day moving average as well at 88.06 level that we highlighted earlier. Then thereafter, right, throughout this low, it actually continued to actually shape up higher and break above this minor descending trend line resistance that is capping previous up move since the high of 19th of September. So this is a very strong impulsive move on the shorter term. So indicate to us that especially the rebound took shape at the 20-day moving average. So indicate to us that this impulsive uptrend move has started to resume for WTI crude oil, which in our platform we call it West Texas oil. So I'll be using 90.30 as my key short-term pivotal support for today, which is very close to this pullback line of this former descending trend line resistance. So as long as this level is not surpassed on the downside, this West Texas oil should potentially could maintain its short-term bullish bias condition to test the next resistance level at 93.80. A breakout above it potentially sees 95.80 next. But however, if we start to see a breakdown below 90.30, then we should start to see another round of choppy corrective down move to retest yesterday's swing low at 80.90, slash the 20-day moving average at 88.06 level. Okay, so switching to a short-term bullish bias for West Texas oil, as long as 90-30 key short-term pivotal support is not surpassed to the downside. Okay, so with that, we come to the 35-minute mark. So a bit more today because of more we call it insights to share. So we should sum up for today's daily dose of market insight. So I wish you all a great day ahead. As tomorrow I'll be off in the first half of the day, so we shall speak again on Friday. Thank you.